right, so here in this video, we're going to be going over market efficiency and why the market moves the way it does. We're not going to read through the disclaimer again, but I just wanted to teach you this about liquidity. Liquidity cannot be destroyed, it can only change hands. So for example, when you see that the stock market is crashing, and if you're around maybe some older people, they have 401ks, maybe some 9-to-5 people, maybe you have a 401k. If you're losing money in the stock market, as far as mutual fund 401k, that means someone else has your money, right? Liquidity is transferred. That means someone on the other side has an interest in being short in that market. So liquidity cannot be necessarily destroyed. It just changes over to the next person. So the institutional side versus the retail side. So you have the Fed, which is basically the regulator and creator of money. They say how much money is out there, and they say what they're going to loan it at. So the Fed will create money and loan that to large banks, and they do it at a premium, right? So if the Fed is creating money, they'll loan it to a large bank at, say, 2%. Then a large bank will trade that to, they'll lend money to hedge funds and small banks, say at 4%. Then those small banks will lend money to normal retail people, as far as businesses, investors. They'll loan money to them at 6%. So you can see how it kind of trickles down. So the Fed, they're basically doing everything with these large algorithms. And this is kind of what ICT teaches on as far as IPTA. What they have is hedging programs that know how to bend and pull the levers on the market. Now, you have large banks who, when they trade, they're mostly following long-term trends. They're not in every single turn. They're not in every single move. What they're doing is just trading their algorithms based on whatever the long-term trend is or whatever they believe the next long-term trend is going to be. Hedge funds are a lot more like retail traders in the sense that they do not have access to billions and billions of dollars of information such as these large banks and such as the Fed. So the hedge funds and the small banks, they're operating from a closer to retail standpoint, but they're operating more so in short-term trends. There's still a lot of hedge funds that are profitable and small banks that are profitable. Now, retail, they're basically speculating. It's going to be generally all over the place. Retail is actually pretty consistent in as far as where they believe the next move is going to be. But, and we'll talk about this in this video, retail is generally wrong, at least at first. They get stopped out, and then it goes in the right direction. And that's being caused by these hedge funds and these large banks, and as far as the Fed and their price delivering algorithm. So the way that I would try to convey to you how the market works is like a bike. So you can see this is the gear where the pedals would be, and then here's the back of the bike attached to the gear that's actually moving the tire, right? So where is all the power coming from? All the power is coming from the pedals, right? Once you pedal the bike, it pushes power back into this gear here, which is more so just the facilitator. This gear really isn't doing much. It's just kind of sitting back, and it's just the mechanism that's allowing this bike to move forward. But all the power, the bike is useless, right? Completely useless. A bike can't go anywhere unless someone is pedaling it or pushing it, right? But that power has to come from somewhere. So the power that's being generated here is generally from retail traders. What these large banks and what these institutions do, and I'm sure you already knew this, they are taking money from retail traders. The retail traders are the power that keeps the mechanism moving forward. If these large banks are profiting in their trades, if these small banks and hedge funds are profiting in their trades, they have to take money from somewhere. Again, liquidity isn't just out there. It's not just money to be grabbed, right? The liquidity in the market is changing hands constantly. And the smart money, right, these banks and institutions, what they're doing is they're building in scenarios where the money funnels toward them. And retail is acting as the energy that's continually putting money in the market, and then these banks are continually pulling it back toward them. So what do we call this? It's kind of like cannibalism, because hedge funds sometimes go under. Banks sometimes lose trades and go under. So the way that I think about it is almost like this image. But, right, the Fed eats the large banks eat the hedge funds and small banks, and the hedge funds and small banks eat retail. So 90% of retail money is going to be lost, right? Or 90% of retail traders are going to lose. But what does that tell you? That tells you that 10% of the market is making 90% of the money. So if 90% of retail is losing, and I'm telling you that they're the power that keeps driving it, that means there's about 10% of the market that's making all the money. And that 10% is generally made up of these three. So again, this is kind of just how I would picture it in my head, as far as you got your Fed, you got your hedge funds and large banks, and then you have your small banks and small hedge funds. And then retail would just be over here in the corner. So with that being said, and if we understand that this is how the market is set up, this is how liquidity is generated, we can compare trading a lot to chess. Now, I'm not a great chess player. I'd probably be beat by someone who's average at chess. I'm not trained in chess. But I started playing chess with a couple friends of mine, and I started noticing that there are very similar principles. And retail traders are given not all the information that these large people have, but they're given enough information to be profitable. So in chess, you're given the exact same pieces as your opponent, and each one has different strategies. Now, some strategies are going to work better than others, right? But if you just use the exact same strategy every single game, your opponent's going to be able to figure you out. So when you're learning chess, your initiation is the same. When you're learning trading, your initiation is generally going to be the same. You're going to be looking at trend lines. You're going to be looking at support and resistance. Where in chess, you're going to be looking at the same opening moves. They're going to tell you, hey, you want to put your pawn here, and then you want to slide this move here. It's very similar to trading. So in chess, what you have to do if you want to win, which is the same in trading, you have to exploit your enemy's thinking. So if you're playing chess and you're playing an opponent, you have to try to think one step ahead of what your opponent's going to do. And so what you do is you have these little plays in chess. And it's like I keep saying, it's the same in trading. If you have a play in chess, you're going to have to exploit that. You wait for your opponent to make a mistake, or you anticipate, okay, if they do this opening move, I know their next 2 or 3 moves based on this opening move are likely to be A, B, and C. In trading, it's the same thing. Say that there's a breakout. I know that retail is going to behave a certain way around breakouts. And so I'll build my strategy and I'll build my play around that so I can outplay that retail trader that is making that move. So why does experience matter more? Experience is going to be the end all be all. Yes, your system is important. Yes, your strategy is important. But your experience and your ability to be open-minded and be able to shift very fast in a positive way, right? Not in an impulsive way where you're messing up, but in a positive way where you can make the right decision in the blink of an eye. Again, that comes from experience. So in chess, again, there's 1, 2, 3, 4, 5, 6, 7, 8 rows and 8 columns. And they're called A, B, C, D, E, F, G, and H. So what they say about chess grandmasters, those are the people who are kind of the elite in chess. These would be like our large banks and our Fed, right? They say that grandmasters can think as far as 15 to 20 moves ahead. So say that you move your pawn, this one here. And I know you're probably thinking, why is this guy showing me chess? I want to learn about trading. Just trust me. This is important. We're laying the foundation before we get into all the technicals. So if you move this pawn here, Your opponent, if he's a grandmaster, he already knows, okay, if he makes this move to D4, I already know 15 moves. I want to move here, 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 right? They know exactly what they're doing 15 moves ahead. And we need to be the same in trading. Now, we don't have to think 15 moves ahead, obviously, with everything. But what we have to do is master one play or one opening. So say that we master this pawn. They open and they move it to here. Now we need to remember that one play. Okay, how do we exploit this move here to get the liquidity or get their king, right? And say they move this pawn, but we've only studied this play and we're really not sure. In our world, I could compare it to counting cards in blackjack. We don't have to trade. We're focusing on one play during one session, and that's it. Because we're playing against these beasts, right? You got to remember, these banks, they're monsters. They spend billions of dollars every single year, billions of dollars to try to beat the market, right? And we have to respect that as traders, especially as retail traders. Retail meaning you're trading less than $10 million. You have to respect it. You have to wait on your one play for your one trade so that you can exploit what your enemy, these banks, what they're trying to do, right? And ultimately what we're doing is we're waiting on a retail play. Because again, retail is driving that bike. It's their liquidity that we're in search of. So when we see a liquidity move where it can be easily exploited, like I said, say we want to see this piece or this piece move to D4. Then we know exactly what we want to do with every single other one of our pieces. That way we can come out positive. So trading is a lot like chess. And one of the aspects to chess is manipulation. A lot of times, chess players, especially really advanced ones, they will make a move that makes you think you know what they're doing. So for example, say that they move this pawn to D4. Generally, they're going to do the same moves, but not always. So we have to start recognizing, again, we're competing against these people, and what we're trying to do is look for that manipulation. And so in trading, what we call that the power of three. And as if you've ever heard, right, things come in threes. This is going to be based on the open, high, low, and close of our candle accumulation, manipulation, distribution. This happens on every time frame, from the 1 minute all the way to the monthly chart. And so what it generally looks like, for example, would be this accumulation. And as it starts rallying, retail will begin to chase that. And that's one thing that you'll hear me say throughout this whole course is retail will always chase. Sometimes they'll be profitable, but over the long term, probably not. I just want you to remember that if you take anything from this course, remember that retail will always chase. So what they do is they make this run up the manipulation. So what are they making retail think? They're making them think it's going to go higher. So what do? They go long and they place their stops back down here where they think it's safe. And then they turn it around and they go and stop out the retail trader. So this is that form of manipulation that we're going to be looking for. Now this is done generally through buy stops and sell stops. And this is a way of looking at orders. And we'll go a little bit further into this. But buy stops and sell stops are the mechanism through which liquidity is facilitated from the retail traders to the smart money traders. So this is our focus. Again, going back to that bike example, the retail traders, they're the ones who are generating this power or generating this liquidity. And the smart money, they're just the ones that are providing the liquidity as far as the market for things to keep moving. But retail traders are providing the actual money that is being taken. And so that is our focus. We're focusing on those retail traders because those setups are going to be the ones that are profitable over the long term. So again, this is going to be our focus. Buy stops and sell stops, we'll go into this in a little more detail, but they're generally above old highs and below old lows. So again, why would there be sell stops at this low? It's going to be because retail is going to chase that price. So what do they start doing? They start shorting in here, start trying to go short. They see a little bit of profit, and then what happens? It comes back, stops them out. Obviously, they don't take the high. We'll get into market structure. But same thing again. There's sell stops below these lows. What does retail do there? They chase. They start going short. They put their stop up here in this gap, comes back up, knocks them out, and so on and so forth. The cycle continues. All right, guys, I hope this video was helpful, and I'll see you in the next one.